I'm Tony Langham. I'm Executive Chair of Lansons, and don't get a chance to advertise much. So we were named Sustainability Agency in our industry, the Reputation Management and PR last week by the PRCA. So I can slip that in, and Adrian can't turn my microphone off. The format of this session is that each of the three, because we're joined with Paul virtually, each of the three panelists are going to speak for around 5 minutes because I think it's really interesting to hear what people have to say and get different perspectives. And we have a massive subject, obviously, future challenges on the road to net zero, because apparently there are some on the way. So each will speak for 5 minutes. I've noticed so far today, the questions have been really good in the other panel sessions. So while I could ask questions, I might just go straight to questions if there are enough, because I think that's been a really rich sort of form of debate in the first few sessions. And then we'll round up just in time for lunch, and Adrian's going to do a quick survey. So the order people are going to speak in for their 5 minutes is Neil, then Paul, then Sarah. So thank you to all for agreeing to be on this fantastic panel. And Neil's going to speak first. He's the Chief Economist of OMFIF, which is the official monetary and financial institutions forum. And Neil, I'm going to hand over to you to speak first.
Well, thank you, Tony, and good morning, pleasure to be here. As Tony said, I'm an economist. I promised to stick to 5 minutes. That's the first challenge, which I think is going to be one heck of a challenge for any economist. But on a serious note, especially when there is so much to say, because on the macro side, as you know, we've had 4 global crises over the past 14 years, if you include the Eurozone tensions. Central banks, of course, took rates down to the floor, and government coffers have been opened again into COVID, leading to high deficits and debt. And many of you will have heard the UK Chancellor last week trying to address that, and also geopolitics and something called inflation. Do you remember that? That started to rear its ugly head again. So in terms of the main macro challenge, if I'm pinning it down on the macro side, I would say that it's probably how and when we get back to some sort of normality, some sort of normal policy. Now, what do I mean by that? Because we've had a decade of very unusual economic times. What I'm referring to is a period when interest rates are above, for some time, inflation, which gives us a positive return on our money. Again, do you remember those days? Secondly, where growth is guaranteed. Thirdly, where central bank is boring again. Some of you may remember Mervyn King once describing the Bank of England and central banking as needing to be boring as a sign of the good times. It's been anything far from that in the last decade. And fourthly, when governments did just fiscal policy and didn't help out financial markets, problems with the pension funds, as we've seen in the last month or so, and dabble in monetary policy and sort of blur the independence with central banks. So the question for me is, how do we get back to normal? The answer in a nutshell is not for some time yet. Firstly, because central banks, as you know, are raising interest rates quite hard and fast, especially in Europe, and of course the UK is included there, into the Northern Hemisphere winter, so what could possibly go wrong? Debt is high, which means that central banks are still sitting on enormous balance sheets, which have implications for all that we do, directly or indirectly. And also, I would argue, controversial, that longer term disinflationary forces are still under the surface when the sort of macro impact of the tragic war in the East starts to hopefully wear away. So in a moment, I'm going to show you a slightly quirky chart. My colleagues would say all my charts are quirky, but let's see what you think. Before I do, I'm just going to throw you a few numbers before Tony, who's a very ruthless chairman, tells me to try to cut down on the time. The first number is 20 trillion. $20 trillion is the amount of liquidity central banks put into the system since 2008 through quantitative easing. Now, just to put that into context, that 20 trillion is equivalent to almost the GDP of the US, or about 115% of the GDP of China. And it's still hanging there to a large extent. So in other words, since 2008, up to the end of the last US financial recession, not COVID related, but financial recession, they have created amongst them effectively a G1 economy in cash terms, which is still pretty much out there in the system. In my view, coming back to the answer, That for me now started as the solution, but it's now become a bit of the problem. And this is where I show you that quirky chart and ask my slide master, Darren, if he could press a button, which he's done fantastically. This is the first quirky chart. It's something I borrowed from the Bank of England back in 2009. This is what they used to explain how they hoped quantitative easing, QE, would work. They quickly stopped using it because it didn't quite work out the way that they were bargaining for. The idea, very briefly, was to push in cash on the left-hand side of the chart by buying government bonds predominantly, but also some corporate bonds. And the cash would then circulate around the UK in two channels. Firstly, upwards in the chart by boosting asset prices, which I would argue did happen, is happening, and probably to some extent will continue to happen. But also at the same time, that cash would find itself going downwards in the chart, landing in everybody's pockets, whether or not they had assets. They would skip to the shops, buy stuff, and we'd have good old-fashioned inflation at about 2% at the end, and everybody would be happy. Didn't quite work out that way. The asset price route worked. The other bit didn't. We tended to save our money or draw down debt. Economists call it a liquidity trap. So they did more of it, and we got into this vicious circle where asset prices continued to be pumped. So that, to me, led to two main things, which have a direct bearing on where we're going at the moment. The first one is, in my view, it sort of widened disparities between those that had and those that didn't have assets. You could say QE went to those that needed it least in general. And secondly, it made generating good old-fashioned demand inflation, for which we got paid, more difficult as a result of that. So just summing up, very long-winded answer, sorry, Tony, to a very good question. Getting back to normal, I think, is going to be one of the biggest macro challenges. To do so without, and it sounds slightly John Major-esque to use a double negative, but without unintended consequences, as central banks continue to raise rates into the Northern Hemisphere winter, and liquidity tends to be pulled away. That, for me, is the macro challenge.
Brilliant, thank you, Neil, and perfectly timed. So not such a challenge for an economist. Secondly, through the virtual world, we're going to Paul. I guess Paul will appear on screen. Can you hear us, Paul?
Yes. Can you hear me?
Fantastic. So Paul is head of private investment for sustainable development at the OECD Development Cooperative Directorate. So, and he's joining us, I think, from Paris. Paul, is that right?
That's correct. Thanks, Tony.
Excellent. Yeah. So thank you for joining us, and the floor is yours.
Thanks. And I'll sort of try and complement a bit what Neil said. I mean, I'll bring some big macro numbers, but again, a big thanks for the invitation to speak today. And I mean, when we talk about big gaps and the sort of situation that we've been pulled into, the sustainable financing goals, which is what I work to every day and sort of aim to close, those gaps have, of course, increased significantly, particularly in developing countries, as we've had those asset owners that have benefited from QE. I think developing countries in particular are at the other spectrum of that. And so that gap in terms of, we like to talk in big numbers, is now 3.9 trillion. There's of course a big fall in government revenues, down by 22%, and therefore the financing needs have increased considerably. And despite that, I mean, looking at the numbers again, the gap in countries represents less than 1% of global financial assets. So I think the topic and responsible asset owners, which we're talking about today, fits in nicely with some of the solution that we will and we're currently looking at the OECD. So, I mean, in particular, COVID has impacted low-income countries. Output losses in developing countries sank 5% to their pre-pandemic GDP, while the additional COVID-19 financing is in low-income countries is between 2021 and 25 is estimated at 450 billion. So the cost for financing the sustainable development is going to increase also because, as Neil mentioned, around inflation. So developing countries are going to have to pay more for that. And that's going to increase, I mean, compared to milder inflation, which is at the global level, 2.2 to 3.4, we're going to see in developing countries an increase from 2.7 to 4.3 between 2020 and 2021. The good news is, and there is good news, is that financing for sustainable development is booming. I mean, asset owners, institutional investors such as yourselves are interested in this asset class. And as we build back better, and as we look and hear from COP27 about what's needed, I think there's some good movements in responsible asset owners. So global financial assets have grown from 11% by 11% in 2019, reaching 469 trillion in 2020. Sustainable investments grew by 15% to 35 trillion in 2020. And on the climate, that amounted to 83 billion. So an increase of 4% that was mobilized. And that's using things that we look at the OECD, like guarantees, blended finance. So, but to be honest, developing countries haven't benefited from the boom. I mean, we've seen movement in certain areas, but they face really significant problems to access sustainable finance. About 97% of the estimated 1.7 trillion in total sustainable investment funds are held in high-income countries. In ODA, so official development assistance countries, that they account for less than 7%, and in LDC, so low developing countries, is less than 1% of cumulative green, social and sustainable bonds issued. So those are really important instruments that I'm going to sort of briefly touch on. And I think, I mean, one of the solutions is to look at these GSSS bonds, but before then, you've got to break down access to barriers in financing in developing countries, align financing at home to improve needs allocation to global goods and prevent global public bads. High-income countries need to advocate at least something like 1% of global financing towards the investments to achieve the highest returns for the SDGs in developing countries. And no single country can achieve sustainable development goals alone. Yet we've got this amorphous big private sector out there that wants to access this. And so we've got to look for tools that can do that. And that's why I'm talking today a bit about green, social and sustainable and sustainability linked bonds, where the OECD has done a lot of work on these particular instruments because they can provide mobilization at size. They can access institutional investors that want these low cost, long return type of instruments, and they put together impact on the ground. So in order to address the climate, the COVID, the conflict that we're seeing in Ukraine, I think that GSSS bonds will be an important part of that. And I hope that responsible asset owners will be able to look at these instruments and see if we can have more issuance in developing countries, particularly in local currency. And I can talk a bit more about that if there's further questions. But maybe back to you, Tony, I think, in the interest of time. Thank you.
Brilliant. Thank you, Paul. And lots of food for thought. And I have no doubt questions that we can follow with later. But first, and thank you for joining us, Sarah. We have Sarah Gordon, who's the CEO of the Impact Investing Institute, to complete our sort of move through macro to emerging markets to possibly closer to home. So, Sarah.
Thank you very much, Tony. Just note the time. It's a great pleasure to be back here. When we launched the Impact Investing Institute in 2019, this conference was one of the very first conferences I spoke at. And I actually haven't seen Adrienne or been back in this space in person since 2019. And I think it's great to be in person again, obviously. But I think also the last 3 years have been challenging for everybody. But there have been some really positive developments. And one of the positive developments, before I talk about two quite huge and potentially depressing challenges that I think we face, is to put it in the context of the momentum that there has been around the responsible behavior and responsible investment and impact investing in this community over the last 3 years. I think that the pandemic has given added momentum to that. I think it's also really demonstrated the type of innovation, and not just financial innovation, obviously, but medical innovation and other types of innovation with which the human race can respond at speed to the huge challenges that we faced from COVID. And I think that 3 years ago, when I talked about impact investing, there were some myths around impact investing that made it quite difficult to engage with all asset owners. I no longer think it's the case that any asset owner managing big pools of capital from the UK everybody knows that not only do they have to take an ESG lens to their approach, to their investment approach, but that they should be really taking impact and the impact of their behavior, their choices and their investments into account. And one of the things that we've done at the Institute over the last 3 years is really build up an evidence base of impact investments across sectors, across asset classes, across geographies that demonstrate that you do not have to sacrifice financial return to have a positive impact. You may choose to do so, but you do not have to do so. And most importantly, that increasingly the direction of policy and regulation is for all of us to be aware of the impact of our money, both positive and negative. And that is only going to increase over the next few years. So to come quickly to the two challenges that I think we need to frame this discussion in. I mean, first of all, there is no transition to net zero. At the moment, looked at from space, we're going in the opposite direction. So the biggest challenge we have as a planet is to make any transition towards net zero. We're going the wrong way. I think that one of the few encouraging things from COP27 was the increasing recognition that to make that transition actually happen, we need to look at it through the lens of a just transition, an inclusive and equitable transition, because the real issue is that for the huge public changes that the transition requires, it is not going to happen unless we take into account mitigating the negative consequences on people and communities and maximizing the opportunities. And Mark Carney, who has done frankly incredible work getting together a global coalition around the Glasgow Financial Alliance for Net Zero, Mark Carney speaks about the climate crisis as the biggest commercial opportunity of our generation. And of course, there's something about that that's a little jarring, but he is right. And I think the evidence base around those opportunities, particularly in the global south, is building. And I hope that that makes the practical challenges that asset owners face in engaging with this agenda, that makes it a little bit easier to do so. The second challenge is the comms challenge. As some of you know, I was a journalist at the Financial Times for nearly 20 years before this current gig. I increasingly believe as I get older that one of the biggest challenges we face as a planet is actually communication and bridging communication between increasingly divided political positions. And that's in the US, it's here in the UK, and it's globally. That what worries me more than just the extremism of the debate and the positioning is the destruction of the bridges of trust and communication between different sets of opinions and different sides of the spectrum. Now, the bottom line is that the anti-ESG, anti-woke capitalism movement, I'm afraid it has to be called now, is very well funded, it's very well coordinated. There is a degree of collaboration across the legal and financial services sectors, particularly in the US, where this community, if I can call us as such, I certainly feel that this is my community, that we should be making far more of an effort to push back against the misunderstandings and misapprehensions that underlie the anti-woke capitalism voices and debate. And frankly, if we don't do that over the next few years, I think we will lose this battle. I really do. I think we will lose this battle and we will lose the war, which is to address the climate crisis. And if we don't do that in 10 years' time, in 20 years' time, we will be living in a world that is so dramatically and horrendously different and difficult, not just for the developing world, but for us in the UK, across the globe. And to fight that battle effectively, I believe we need to try and speak with a collective voice as much as possible. So I can go into more detail about either of those big challenges, but I've stuck to time, so back to you.
Brilliant, and thank you, Sarah. Another fantastic contribution. I'll just ask a couple of quick things. I will then go to the floor for questions. I mean, Paul, from the OECD's point of view, you talked about the importance of GSS bonds, and I recognise that was a bit of an urging message, but what's been the response so far? How do you think the asset management industry or asset owners are responding? Do you feel positive, or do you feel that there's hurdles to be overcome?
Definitely. I mean, I think there's strong appetite. I mean, we hear this, the greenium, so that there's more sort of demand than they can be issued, but there are issues in terms of some of the filters that are placed on ESG that stop developing countries being able to access them. There are issues around the credit ratings of developing countries that stop institutional investors buying these types of asset class. And then there's, I mean, what Sarah spoke about a bit, there is a bit of a push back, and but I think overall there's a strong movement and recognition. And I mean, as long as we have this greenium, and the needs are so significant in developing countries, and the opportunity as well in terms of the future of economic growth are going to be in places like Nigeria and other parts of sub-Saharan Africa and Asia, that there is an opportunity for long-term institutional investors to help shape these markets and help access these GSSS bonds. But it's also up for donors to help, I think, and that's where they can come in and use things like guarantees. So governments also in OECD countries need to play their part. Thanks.
Yeah, thank you. Because you were obviously you were enthusiastic about that, and Neil, I wanted to draw you in as well. One of the questioners in one of the earlier panels said actually there are fewer emerging market funds and money going in rather than more, and I find I can't go into a room with some clients without talking about the impending developing market debt crisis or emerging market debt crisis. I mean, Neil, do you want to go first? That's a reality, isn't it? Aren't we going to have to go through that first?
For many, yes, but not for all. I'm maybe a little more sanguine than some on this. I say it because the so-called new normal brought its challenges when we had borrowing costs on the floor for too long and plenty of liquidity. But adapting now to the normal, the old normal, brings a different set. And I say that because in terms of an analogy, as interest rates go up, I see it as as the tide of liquidity goes out, it'll begin to expose the sharp rocks underneath. And one of those sharp rocks by asset class tends to be emerging markets, speaking in general, especially if it's in twin with a strong dollar environment, which clearly we're in, and I think we will probably continue to be in going forward. Things have moved on a bit, and emerging markets, I believe, are no longer a single asset class. They spent a lot of the post-08 recovery that we went through getting their own houses in order. And Paul mentioned earlier in terms of bond issuance, hopefully in local currency. That makes a lot of sense because we're living now in a high debt world. It's not just the legacy of COVID, and I'm going to come back to that a bit later. It was rising before. But it jolly well helps if you've got debt denominated in the currency that you can print. Thankfully, the US, the UK, Japan, and the Euro area, if they remain in the club, can and have been printing money to finance that debt. What could possibly go wrong? Well, that's one for later. I'll come back to that in a second. But in the short term, it means you needn't default. Many emerging markets now have reduced their external hard currency debt ratios. There are obvious vulnerabilities, those that have big external needs, such as Turkey, Argentina, and of course, Ukraine, as it will need to reconstruct its economy. But for the most part, these are now more manageable, and hopefully we will see a move towards more local currency issuance where it's needed. And if these countries then meet debt strains in local currency, guess what? They can start to run quantitative easing as well. So on the emerging market side, there are red lights in terms of strong dollar, rising interest rates, traditionally not good for emerging markets as a whole. But I think things have moved on, and it's no longer a single asset class, and we can be a bit more selective now.
Okay. Paul, does that accord with your view, or how would you comment?
Yeah, no, I mean, I think very much in line. I mean, and I think there's still sort of frontier markets which we're sort of involved in and worry a bit about. And those were the SDG gaps are the largest. But I mean, yeah, I mean, Neil's correct that there has been a bit of change, and I think there is a sort of new look on emerging markets. I mean, we did have a unique opportunity, like everybody in many countries benefited from very low rates. The mortgage and the sort of the checks were all credit cards were made use of the very cheap financing, and I think we missed an opportunity to do some long-term financing, and it's going to be more difficult and challenging now for developing countries. So there's going to be a bit more that's going to need to be provided by OECD countries to help those countries transition. And that means you've got to sort of encourage more issuance, regulatory. You've got to think a bit about, I mean, providing insurance, looking at the impact. So second party sort of verifies that what they say in terms of the bonds are delivering. And I think we will see definitely debt restructuring as the sort of tide goes out. But then there is an opportunity, I think, for entities like the IMF to say, well, we want you to restructure your debt and issue GSSS bonds so that you build back green. And so that there's, out of a crisis, you can make the most of it, and also try and get as much of that in local currency. But it's not always easy in some of these more volatile jurisdictions. So, yeah.
Thank you. I'm going to ask Sarah a question, then I'll come to you in the audience. Sarah, I have to ask you about your communication challenge. I mean, you mentioned how so many views are polarized in so many areas. I mean, my observation from my working life is that that's made lots of corporates and chief executives more timid and wary of public debate. So I was listening thinking, who's going to fight this battle? Because as you described them, the anti-woke capitalists are going to use colorful language. They're mobilized in the United States. They're very mobilized. Who's going to fight this battle that all of us in the room need?
So I think there's a dual responsibility here. I think the media has a huge responsibility, but I also think there's a lot that we collectively can do to support the media. You know, fortunately, things like climate science is moving incredibly fast. Part of it is an education and sharing of information challenge. Secondly, it's about, frankly, building coalitions that can respond as powerfully and aggressively as some of the voices that are attacking ESG and defending the fossil fuel future. And those coalitions need to be constructed. I think that they need to involve very senior people across business and policymakers and the multilateral organizations, the development finance institutions. And I think there is also a responsibility for business. And I mean, it's not really, it's less the financial services industry, it's more the corporates that I think, although it is true, it's been very interesting coming out of journalism and looking under the hood a little bit more in the sort of C-suites around the city, is that there is, as you say, increasing wariness among chief execs and C-suite executives about being open with the media. Precisely at the moment when you actually need more openness and more engagement and a commitment to building trusted relationships with particular journalists, a commitment to step out of your comfort zone in terms of the conversations that you're prepared to have. So, I mean, part of what Paul has been talking about was also part of our work last year as under an impact task force under the UK's presidency of the G7, is that this is not a sequential thing. We cannot wait for policymakers to do something and then we'll do something, or we cannot wait for the media to do something and then we'll do something. All of us have a responsibility to act now. And part of that responsibility is stepping out of our comfort zones, both as asset owners, as asset managers, as policymakers, as journalists, and indeed in civil society. So I think there is, you know, there are particular practical initiatives that need to be done, but also I think there's an attitudinal change that we frankly all need to embrace.
Brilliant, thank you. And I'd love to keep asking questions, but I can go to the audience. So raise your hand if you'd like to ask a question. There's a woman there, a man in the far corner, and a man on the back row. If we take those three, and then we'll maybe take one more after that. Thank you.
Another question from me. I'm enjoying the debate. Sarah, you make such a key point, and the article that you wrote on the FT on responsibility of media was fantastic. Thanks. So well done. And just for the other people here, I think finance has a role because disclosure is really important for that trust factor, where I think media is stepping in, where finance is stepping back. So I think it's crucial. And I think there's a place for lawyers to make sure that they empower finance to step up and don't recommend that they step back. That was my comment. But my question more is about frontier and emerging markets. You talked about the fact of the need to move away from hard currency and local currency into frontier markets. We're in a risk-off environment. I'm interested the pathways that you see for private investors into those markets, because what you've mentioned so far, debt restructuring, feels very much at a multilateral level. But how are we going to get private money into those areas as well, especially with the currency risk?
Brilliant, thank you. And then question, there was at the corner over there, and then back row over there. And we'll take questions together. Yeah.
Sorry, another question for you, Sarah. Apologies. I just want you to talk a little bit more about why you've conflated anti-woke and anti-ESG. Can you not be challenging of some aspects of wokeness, but wholeheartedly pro-ESG?
Woke capitalism, I think, rather than anti-woke.
And then back row there.
Thank you. Yeah, just want to echo that sentiment from the front that actually, Sarah, I think your call to action was equally depressing and inspiring. So you've certainly had an impact there, but also to all of you, of course. I think that the thing that I keep coming back to in terms of I suppose, both the economics and the communication of this is, are we presenting good news or bad news? So when you look at the exponential 20th century growth model, are we presenting a 21st century model, sustainable economy that can outcompete that? And I doubt we are, I suppose, is the economic version of that question. And if we're not, if we're saying the reality here, you can have your anti-woke capitalism denial, but the reality is it's going to be tough. How do you then present the opportunity of dealing with that reality as a positive, despite the fact we're dealing with the reality of a net negative? So there's an economics question, and there's a communication question there.
Okay, thank you. I will. So let's do reversal. So Sarah, do you want to go first? We'll go Sarah, Neil, and then Paul. I guess. Well, you had a couple of questions there.
I'll be quick. I should have been specific that I'm talking about anti-woke capitalism. So if you are, for example, Ron DeSantis, who I think many of us regard as a much better alternative to a potential repeat of the Trump presidency. But he has been very specific about getting woke out of business, getting woke out of capitalism. And by that, he means the quite narrow ESG financial agenda rather than the broader social woke agenda. So I think, apologies if I wasn't specific enough on that. A very specific example to respond to your question is around the legal challenge, that your point about the responsibility of lawyers, so important. In the US, a lot of the pushback against ESG is now being framed in terms of antitrust, using antitrust legislation as a way of pushing back against, for example, coalitions like GFANZ or the many other coalitions and collaborations that are so necessary to advance this agenda. So I think the role of lawyers is incredibly important. On the getting money, mobilizing money to emerging markets, one initiative that we're advancing is the Just Transition Finance Challenge, which is both about raising awareness of the necessity for a just transition, but also about the actual mobilizing of more capital, particularly to the global south, for a just transition. And to pick up on a point that Paul made, there are such exciting innovations out there in the market, not just of private capital initiatives, but also of the role of public and private capital working together in more blended finance structures, whether that's decreasing risk for the private capital, whether it's guarantees, as Paul mentioned. There are lots of case studies around that, and our challenge is already grouping asset owners and asset managers with more than £4 trillion in assets and assets under management. So very happy to share more about that if relevant.
And thank you, sir. And Neil, I mean, happy for your views on this, but is it the pathways for private investors that you would talk about? I'm going to go to Paul as well on that. But.
Yeah, it's on the EMs. It's a tricky one. Completely agree. We're in a bear stroke risk off environment to a far greater extent than we have been. Does that bode well for so-called risky strategies? And EM tends to fall under that umbrella traditionally. Well, no, it doesn't. But for reasons earlier, it does seem to me that if on a selective basis, the sort of EMs that should be targeted, private money or public money even, would be those that have good solid debt ratios and those where perhaps they are issuing in local currency, but whose exchange rate, whose currency itself you trust. Now, that doesn't sound so wild in a bare leg when some of the developed market currencies are looking a bit shaky. There's one very close to home at the moment, sterling, that has been hit. And if you look at the underlying macro fundamentals, you could argue it still looks shaky. Compare that to some of the other, that was Freudian, some of the emerging markets, whereby you may prefer currency risk taking that on as a hedge, but that is a far more difficult environment. Completely understand that. On the sustainable growth argument, I'm slightly less sanguine because GDP is the benchmark being used by policymakers, and they're the ones that count. And of course, it's the quantity of GDP that matters to them, not the quality of GDP. GDP doesn't really take into account the finite extent, for example, of the planet. And there are plenty of arguments to drop GDP and look at something else. However, we are, like it or not, in a high debt world, highest government debt ratio since the Second World War. And addressing that debt, as we saw last week in the UK, doesn't win elections. That's one for later, in which case the policymakers, government especially, but also to some extent central banks, are going to have to continue to rely on beefing up GDP numbers. It's the quantity of GDP rather than the quality of it. So I'm a little less optimistic about the second point than the first one.
Yeah, thank you. And Paul, I mean, I think you actually did a pretty good presentation of the opportunity, but just interesting your views on the pathways for private investors in a risk-off world. How would you answer that?
Yeah, I mean, I'll answer that and just go into a bit on the FX risk. I mean, let's be clear. I mean, the emerging markets, the sort of buckets that we use for that are a bit skewed. I mean, you've got South Korea, Taiwan that are included often in that. So, and the sort of recoil from the dollar and the US Fed hasn't been as bad as we had expected in terms of sub-Saharan Africa and their COVID impact. So the story, I mean, the opportunity is still massive out there. I mean, you've got 20 million Africans joining the job market each year. You know, so the future economic opportunities are in those emerging markets. And that's also where you see the most opportunities for renewable, but also where they're most exposed to climate. So in terms of building and using GSS bonds and addressing the SDGs, that's the place to go for economic returns, but also in terms of addressing climate. And there are really good opportunities out there still. Vietnam's an exciting market, and the innovation and sort of enterprise in some of these countries is just fantastic. On the FX, I think, I mean, what we're trying to see is a bit more where you get dual listings, for example, and you can get Thailand did a GSSS bond. They issued it on the stock exchange of Luxembourg, and they can do that in local currency. So you can access those deeper pools of capital on these exchanges. You're also seeing a lot of funds and facilities, this whole concept of blending that Sarah spoke about, where you're mixing private capital with concessional and non-concessional public development finance. And that allows you to sort of create sort of first losses, and those funds can address and help access those developing countries by having those blending structures and instruments in them. And that can be anything from the PPP to sort of syndication, and that allows the private sector to come in at scale and feel comfort in investing in those countries. So we need to have more of those that focus on FX, but we're also starting to see guarantees being issued by donors in places like Guatemala in like Swedish krona. So and that the guarantees working in that currency and helping those markets. So despite some of the project being in local currency, so there are mechanisms and approaches that can help drive this much needed investment. Thanks.
Brilliant, thank you. Now we started a few minutes late, but I think we should just move to the last question, because and then Adrienne wants to ask audience as well. So there was a man with hand up before towards the back there. John, we'll just take last question. If you can get a microphone to that man there, please.
Thank you very much. It's been a really fascinating discussion, particularly around the just transition and the impact side of things. And for me, there's almost a paradox. On the one hand, this is the biggest commercial opportunity of our lifetime, and yet there's no transition. You know, the world is operating pretty close to business as normal, yet we have all these disclosure frameworks happening. So we're trying really hard, which is the natural question is, well, what's going wrong? Is it that we need to hold people's feet to the fire more? Is it that we need independent reports from third parties? What do we think's missing here? And what can we do as asset owners just to move the dial a little bit more in the right direction?
That's a brilliant question. Thank you. Now, can I suggest panelists, and we'll go reverse order than we started. So we'll go Sarah, Paul, Neil. Can we take that as the what's going wrong, but also what we talked about before, something towards a solution that you'd like to see in 2023, something shorter term that you'd like to see. So maybe what's going wrong, but also your thought on something positive that you'd like to see. So Sarah, if I come to you first.
So I think there are a lot of positive things have happened over the last 3 years. I mean, 3 years ago, when I talked about impact, the biggest issue that people brought up was the plethora of reporting requirements and frameworks, and people were developing their proprietary frameworks. I think the situation is nowhere near easy enough and enabling enough for you guys, but it is better than it was, and we are moving to converged global standards around sustainability. So that is going to help. I would say the biggest blocker, but I'd be very interested in pushback, is for an asset owner, it's the understanding of your fiduciary duty. And we have done a lot of work around reassuring asset owners and asset managers that fiduciary duty is compatible with impact investment and taking negative and positive impacts into account, as well as financial return. Frankly, I think that the most useful thing, the unblocker in the UK, would be a reframing of fiduciary duty that is fit for the 21st century. That's something that DWP needs to do, that DLUC needs to do for the local authorities' pensions. But I think that would make life easier for fiduciaries. And frankly, that's what we're about at the Institute, is we need to make life easier for the asset owners and the asset managers that are wanting to move in this direction, but really struggling.
Thank you. Really strong answer. Paul, go to you next for something you want to see, and also the take on what's going on.
Yeah, no, thanks for that. I mean, excellent remarks from my co-panelists, and some great questions. I mean, from the OECD perspective, we've seen massive build up on the mobilization agenda. We've seen Janet Yellen just come out before the World Bank meetings. We've helped the G20 under the Indonesian presidency develop blended finance principles for less developed countries. So we've seen a massive kind of movement. What we need to see is in transactions, money and flows and projects on the ground and impact in terms of climate, gender. So all these are crucially important. So the evidence. What I'm seeing in terms of some of the blockages, well, it's the ESG a bit in terms of the regulatory framework around that, financial regulations as well, the filter that is imposed on investing in Nigeria because of the governance and other things. And what I would like to see is something from the private sector to say what exactly they are doing in terms of their investments, and moving from ESG to SDG, and saying we are going to allocate 3%, 4% of our portfolio to developing countries, to certain thematic sectors, be it climate, water, or whatever, and stick to that, or at least have goals that they can be also held to account, a bit like governments can. Thanks.
Great, thank you, Paul. Fantastic comments, and Neil, to you for the last word.
I've got very little to add to what the experts have said on that, other than Sarah mentioned convergence of global standards. When I know Tony had tucked up his sleeve a final question, which was about what are the actions needed. I was going to say on the macro front, what we need is responsibility from institutions going forward, and doing the right thing, both nationally. And a good example again is the UK, where it doesn't help when governments start to malign the institutions that they will need to rely upon, as we've had in the last couple of months, especially in the high debt world. And secondly, globally, if possible, going forward, to coordinate a bit more, because one of the, just in case you're too upbeat, one of the great jigsaw pieces from the 1930s that hasn't yet come crashing into place is political distrust and a bit more protectionism. And the US election also is going to be an important part of that. So all-round responsibility, I hope, is going to come more from institutions than we've had in the past.
Brilliant, thank you. And please don't rush off, because Adrienne has got a poll up her sleeve, but please thanks, fantastic panel for contributions today. So thank you, Sarah, Neil and Paul. Thank you very much. Thank you, Paul.
My poll question is actually 3 questions. I'm not entirely sure, even though it's my event. I've no idea how the polls work, but basically we've asked you 3 questions. The first one being, to what extent do you feel COP meetings are important or relevant to the way you build your investment strategies? We've got very much, not at all, or slightly, and I don't know if the answers are going to come up. We've got, has war in Ukraine impacted on your ability to focus on net zero within your investment strategies? Same options, in slightly different order, just to check you're still awake. Which area, finally, of ESG investing do you believe has the biggest opportunity? E for investment, S for social or stakeholder, as some people would like it to be called, or G for governance. So are the results going to pop up now, Darren?
One that's all 3.
Sorry?
Why don't you have one that's all 3?
Well, that's kind of what I was hoping would get, but you know, I don't know what's going to come. Please fill in the survey. Oh, okay, right, fine. So now you do it. So if you could do that now, then we'll get the results. Yeah, Sarah has to leave, not because I've offended her, not well, not yet. And Sarah has been with us since 2019. I hadn't realized that the Impact Investing Institute started at the same time. So ours was the first big event, as she said. So it was wonderful to have her. Are the results coming up, Darren? Darren's actually sat behind the podium so that I can hold faces at him, I can see. So to what extent do you feel? Slightly, vast majority. I mean, it's changing slightly, but gosh, only slightly, 67%. Right. I mean, I wonder when they're arguing about what the final statement is, and it's taking all that money and everybody's flying in to talk about climate change, you go, anybody hear about virtual meeting? But okay. Right, next question, please. Has the war in Ukraine impacted on your ability to focus? Right, okay, well, that's interesting. Slightly, only slightly, again, not at all, very much. Only 16%, oh, there we go, 19. Wow, I don't know what I expected the figures to be, but I don't think it was in that order. Next one, please, Darren. Which area of ESG investing do you believe has the biggest opportunity? E for environment, S for social stakeholders, some people think it should be, or G for governance. Okay, so by a long way, it's the environment. So I kind of think that's encouraging. And you've earned your lunch right now. You've been a great audience so far. I hope you'll come back afterwards, because we've got some great speakers for you then. Ladies and gentlemen, thank you for your attention this morning, and I'll see you after lunch.